Alright guys, we're going to do a video on order blocks or supply and demand zones, which for all intents and purposes are the same thing. So before we dive into this, I just want to first highlight what an order block is, right? And then why an order block works. So I think that why an order block works, like the underlying market mechanics, is typically lost on most traders. I mean, a lot of the traders that I speak to, they don't really understand, what's inside of an order block that actually causes a reaction. Why would price change direction at this specific level? And I think that that is absolutely integral to any trading component, right? Any confluence, any strategy, any mechanical understanding that you have of the market. Trading something because it works is completely different than trading something because you know why it works. So whenever I'm learning something new, especially when it comes to trading, I want to understand, why would this thing work? Why should I be interested in this? Not just does it work, right? Because how am I ever going to know which ones work and which ones don't, or whether or not it's something arbitrary or something I should really give my attention to? So with everything that you learn in trading, you should have that question at the forefront. Why does this work? So we're going to deep dive into that today. I want to show you guys why order blocks work and how you can use them to catch amazing trades. So an order block is going to be the last opposing candle before a displacement move. So in this case, for this bearish order block, which is going to be this red block right here, we are going to look at the last bullish candle. So this is the last time that buy orders were hitting the market and buyers were in control before price sold off lower, right? Now, the more aggressive the sell-off, the more aggressive the displacement of the move away from that last candle, the higher probability that you're going to get a reaction when price returns back to that zone. And that's where we're going to get into why an order block works. So if you think about what's happening here, and this is a relatively weak order block that we're using for this example, but we'll show some stronger ones here in a second. But if you think about why it works, so the market was balanced, buyers and sellers were, fighting over control, and then all of a sudden sellers overwhelmed buyers and price displaced away. Now it could have been the other way around. This could be a bullish order block and bulls overran the bears and price displaced upwards, right? But in this moment, somebody stepped in with enough selling power to overwhelm the bulls who had been driving price up and start forcing price the opposite direction. Now, sometimes that can be a collective effort. It could be many traders, algorithms, institutions, just all kind of want to go short at the same time. But a lot of times it's representative of a big player entering the market, somebody with enough selling power to really change the direction of price. And what will happen is when price comes back to that area, that seller is going to defend that area. And by defend, what I mean is they will most likely add to their position. Institutions trade pullbacks too. Institutional algorithms also trade pullbacks, just like a retail trader. If they got in on this move and they still think that the move is valid and has potential, when price pulls back into it, they often will add to their position. Now, something to consider is if you're a big seller and you go into the market with 10,000 contracts, and say it's Asia session, right? Low volume. You go in with 10,000 contracts, you're going to force price to move away from your entry. Just the action of you entering the market, your sell orders are going to force price down. Now what happens is when you go to enter with the next 10,000, you're getting a crappy fill. Now you're entering the market down here instead of up here where you wanted to. So a lot of times what institutions will do, or large players, is they will enter the market, 10,000 contracts, 20,000, whatever the number is. Price will move away. They'll wait for it to come back to this area, and then they'll enter with another 10 or 20,000, ensuring that all of the contracts that they wanted to get into that position, or as many as possible, got that optimal fill price that they were targeting. So besides that, there's a few other things that are happening when price returns back to this area, and we're going to just briefly go over what those are. So the reason why order blocks or supply and demand zones actually work as well as they do is four things, right? Institutions that didn't finish buying or selling may add to their positions. So that's the one we just went over. Traders who missed the breakout, which is going to be the displacement move away, may finally enter the market. So they see price come back, they missed the initial move, they say, great, we're coming into the order block. I recognize this as either an order block or supply and demand zone. I'm expecting a reaction. Let me enter in on this position, right? So institutions are adding, retail traders are jumping into the move, right? The other thing is the displacement. So let's say in this case, it's a bearish order block that we were just looking at. Price is displacing downwards, right? So that means that anybody who's long in the market right now needs to exit their position. So price comes back, and they determine, hey, you know what, I need to close my position. When they close their position out, their market buy order that they entered with now becomes a market sell. And in this case on the screen, which says short sellers become trapped in cover, but you get the point. Whatever direction that the order block is supposed to cause the reaction, the opposite traders, right, are going to exit their positions, which is going to further increase the probability of that bounce. So and we'll go back to the chart here in a second to kind of go over how that one's going to work. But then the last one is algorithms recognize high liquidity areas and join in. So algorithms also recognize supply and demand, and they also recognize order blocks as places where a lot of other traders may engage the market. So because of these four things, you have institutions that are adding to their positions, traders jumping in last minute, the opposing traders who are trapped in their moves now exiting, and their orders becoming the opposing order, which now supports the reaction as well, and then algorithms jumping into the mix, like maybe high time frame, high frequency, whatever the case is, algorithms, momentum algorithms, ignition algorithms jumping into the action last minute. But all of these things combined mean that when price reaches that area, a tremendous amount of buying or selling pressure, it gets triggered, and as it does, it causes the reaction, and you see the move away, and that's what makes supply and demand or order blocks work. Now, knowing that, and let's go back to the charts here for a second, you can figure out which order blocks are likely to cause the highest potential for reaction. And the way you can do this is by looking at which order blocks created the biggest amount of displacement and when that displacement was. So this isn't going to be like a foolproof, flawless way to do it. You're still going to see order blocks react that you wouldn't expect, and that's just because of institutional involvement. You don't know where or when they're entering or why. Sometimes you can kind of figure out this spot's maybe a little better than another, but at the end of the day, you can't see behind the scenes entirely. But like we'll use one of these order blocks that's coming up here as an example. So this one right here, right? So this order block, as you can see, price is going up, right? It's going up. Nothing too crazy going on here. But then we get the sharp move up. And this is a little bit more aggressive of an angle than some of these other moves. Now, I'm not saying that I would have necessarily called this one out in the moment, but it's just an example of what you're looking for. You're looking for an aggressive move up, and you're looking for it to be the start of a large displacement. Price comes back, and it reacts off of this one, whereas with this one, it chewed right through. Now, if I was to look at this order block, and I was to look at this order block, I don't know if I would really say that I would expect this one to get sold through. I don't know. But what we can do is play this forward until we see an order block that we are relatively sure of, one that does have enough displacement behind it that actually looks pretty convincing. Now, while we're waiting for that to happen, as we're going through this, I want to go over what a breaker block is. So a breaker block is an order block that gets traded entirely through, and then flips over and becomes support and resistance. And we'll see an example of that shortly. So now I just want to go over something. So this right here, this order block, it caused this big move up, and you can see price came down and it tapped it, and boom, reacted right off of it, right? So seeing this little wick into it and then an immediate rejection and move upwards might be a hint that this order block has some potential to cause an aggressive reaction. So now you see we came back, we traded to the 50% mark, which is going to be called the line of consequent encroachment, and boom, we get a powerful reaction away from it. So just something I wanted to point out, you might be able to use a wick through rejection where we just tap it and then immediately pull away as a little clue that order block might have some reactionary power. Now, one thing to keep in mind is every time price touches an order block, it is going to deplete some of its reaction potential. It doesn't happen 100% of the time, right? Sometimes you'll see 3, 4, 5 touches of an order block, and it'll continue to cause reactions on each touch. But largely, you're going to get that first touch is going to be the strongest reaction. The second touch is going to be a little weaker. The third touch, probably going to trade through it. So just a good rule of thumb, don't keep looking at the same order block unless it's just an absolute behemoth and saying, okay, well, every time price gets to this area, it is definitely going to leave it, because you're probably going to get wrecked in those moves, right? So you got to treat them as something that does get exhausted. And if you think back to the mechanics that we just discussed, that makes perfect sense, right? Every time price comes back, people are adding to their position, and algorithms are jumping in, retail traders are jumping in. Well, eventually, those people aren't going to keep continuing to do that. Every time price gets back there, they're not going to just continuously add endless contracts to it. And everybody else knows how order blocks work too, and knows that there's only so many touch points before finally it doesn't work anymore. So each time the reaction is going to get a little bit less aggressive until finally it doesn't work. Now, I'm going to show you real quick here. We do have a breaker block. So a breaker block is an order block which has been depleted in some sense, and maybe that just means we traded right through it. We never got a reaction off of it, but it's been mitigated. By mitigated, I mean we traded completely through it. We've invalidated it as an order block or a supply and demand zone. You can see this one right here is the last opposing candle before this aggressive move down right here, and we're on the 5 minutes. So this is a big move. This is several hundred points down to the bottom of this. We come up. We hit it. We get a very aggressive reaction down to this other order block. Boof, aggressive reaction off. Later on, we come back to this order block, and the force of the buyers here is strong enough where this time we don't get a reaction. We just poof, trade right through this. But what happens is this order block flips over, and it becomes support or resistance, in this case support. Now, why is it that this happens? Well, this is another important mechanical understanding that will really benefit you in the markets. Is a lot of people are looking to enter their positions right here. That's part of what causes the reaction, right? Price comes back up to this area, the institutions go, great, let me get some more sell orders ready, poof, and they start selling. Retail traders, I'm expecting a reaction right here, they start selling. Algorithms, I think price is likely to depart this area with a reaction, let me enter, right? Well, the same goes for when price trades through. Now what happens, and I do this in my own personal trading, when I see price chew through an order block and trade through the other side, now I'm thinking, okay, price has enough momentum that it was able to pass through this order block. It's likely that it's going to continue in that direction. I mean, God, if it had enough momentum to just blast right through this area that should have caused a reaction, that means there's a lot of buyers in the market, so I will more likely to not go long. And a good place to go long is on the pullback. So this is why you end up seeing these become support and resistance. Is there's now people who are viewing this, whether that be institutions, algorithms, or retail traders, and saying, great, this is a great opportunity to go long in the market now. This order block failed, that's my entry signal. So now, and you can see this happen right here, right? People went long in the market, price went up, it came back, they defended, they probably added on this pullback, poof, price goes up again. That doesn't mean that these things will definitely hold up, but you will see a lot of times, and look, see how price up and away, right? So if you had waited for this order block to fail, then you had entered here and then added to your position here and then went long, that's an amazing trade right there. And like, I'll see how far this thing ends up going in the end, but so far, boom, 176 points, right? Off a 5 minute order block where you just sat patiently and you waited to see what happens. Do we trade through it or do we get a reaction? Now, we'll take a look at this order block up here. Now, this is a great example of a strong order block, right? If you look, price shot way up previously. And then we get here and we get the last buyer in control candle. And then, poof, aggressive selling, right? Aggressive selling. This move just from up here to here is 666 points. So it's like, close to 700 if I measured the ends in there too. That's a lot of selling, right? Definitely indicative of institutional involvement. Institution came in here and started dumping positions. They either, and likely what this was they took profit on their longs, right? They were long, they got up here, they took profit. They knew when they took profit, those were going to convert to market sells, right? Because if you're in a long and you close it, that becomes a market sell. So then they start selling, right? If you're going to take profit on your long, you might as well go in short too at the same time and ride the wave that you're creating down. So anyways, this is an order block that was formed with an aggressive displacement move. This is one where I would expect a reaction to happen. It's not one that I think is arbitrary where price is just going to randomly trade through it. You can pretty much count on a reaction here. The only time there's not going to be a reaction is if the buying is so aggressive that it manages to just punch right through and trade out the other side, but that doesn't happen very often. So the way that I would typically trade these, and the way that I think most people trade them, is they use the line of consequent encroachment. So by line of consequent encroachment, what I mean is we are going to enter a sell position with a limit order. And oops, I didn't mean to do that. Let's close that out and sell. limit. Let's drag this up here. Now most people are going to enter like thereabouts the 50% mark, and then I would target the opposite end here personally. Target the next known area for reaction. Now what I do is I either set my stop loss a little bit behind the order block or supply and demand zone, or I set it right at the other side of it. But I typically tend to give it a little bit of space to breathe, which sucks because if the order block fails, you're going to take a little bit larger of a loss. But that's where asymmetry comes into play. I mean, you're risking $770 in this case to make over $3,000. So this is like a little bit over than 4-to-1 trade. So you got to rely on asymmetry to save you. But the reason I do this is sometimes we hit the order block with aggression and we get like a wick through, and then the order block holds and price slingshots the other way, but the wick through knocks your stop. So it's entirely up to you. Back test and see what makes the most sense. I know that went super fast. We'll just try to rewind that a little bit and do this to like here. We'll go back to here. Now, obviously, it's not going to re-enter me into the trade, but we got tagged in right here, and we got tagged out down here. So, super easy to use these. The indicator that you see on my screen is one that I custom built. It uses 2 different types of order blocks, so it's looking at 2 different criteria to determine what is an order block worth viewing. And then it also has auto mitigation. When price trades through an order block, you'll see the colors will change. Like this one changed from a red bearish order block to this blue breaker block now, which is going to be a mitigated order block, so that way it's easy to identify on the charts. So I built this indicator myself. It is up on my TradingView account. You can download it 100% for free. It does mark out the line of consequent encroachment. There's a bunch of settings in there if you want to customize how many show up on your chart, or you want to be able to change the colors, or you want to change the mitigation criteria, or whatever that is. You can go to xrstrading.com and click on my TradingView profile, and you'll be able to find this indicator. Alternatively, you can just go on TradingView, type in XRS order blocks, and you're going to find it that way as well. So anyways, I hope this helps you guys catch some banger trades. One final parting piece of information, just a good little tip. The higher the time frame that you view the order block on, the more likely it is to have institutional involvement in it, right? So a 1 hour, a 4 hour, a 15-minute is going to hold a lot more credence than a order block that is formed on the 1 or the 5. So 5-minute order blocks are fine. 1-minute order blocks also work sometimes. 15, 1 hour, 4 hour, those are going to be absolute bangers. All right, guys, catch some great trades out there.